Have you ever paused to think about how the food on your plate, whether it's like a ripe avocado or a loaf of bread, connects back to some of the world's most fundamental industries?
Mm.
It's easy to overlook, right? But there are giants working behind the scenes, literally rooted in the soil, ensuring our global food supply. Okay, let's unpack this. Imagine a company that's deeply intertwined with the earth beneath our feet and stretching across the entire globe, making sure we have food on our tables. Today, we're taking a deep dive into Nutrien Ltd, ticker NTR, a true titan in the world of crop inputs and services.
Yeah, what's genuinely compelling here is that Nutrien operates at a scale that profoundly impacts global food security. Yet the intricate dance of its business, from volatile market cycles to its ambitious sustainability efforts, is often, well, underexplored.
Uh,
For this deep dive, we've pulled together a pretty robust stack of sources. We've got a detailed initial report from Next Gen Investors Endowment, an insightful YouTube analysis from Sven Carlin, PhD, and critically, Nutrien's own recent Q2 2025 results hot off the press.
Right. So our mission for you, the listener, is to go beyond the headlines. We're here to extract the most important nuggets of knowledge from these, diverse sources. We'll help you understand Nutrien's core business segments, dissect its competitive advantages, and really grasp the intricate market forces it navigates. We'll be looking at everything from the cyclical nature of essential nutrients like potash to the nuances of its latest financial performance and what the future might hold.
And this leads us to a crucial consideration. How does a company of this sheer magnitude, operating in such a vital and, let's face it, often unpredictable sector, manage its relentless growth?
Hmm.
How does it effectively mitigate significant risks and strategically position itself for a future defined by, well, rapidly expanding global population?
Right.
We're going to connect these dots, providing you with a holistic, well-rounded view that will quickly make you well-informed on this critical, often unseen player in global agriculture.
Okay, great. So to kick things off, who exactly is Nutrien and what do they do at their very core?
So at its foundation, Nutrien is a powerhouse Canadian fertilizer company. They're headquartered up in Saskatoon, Saskatchewan. Its story really began in 2018, forged from the colossal merger of two agricultural giants, Potash Corporation of Saskatchewan and Agrium.
Right, I remember that merger. Big news at the time.
Huge news. And this wasn't just a simple combining of assets. It was a strategic move that brought together complementary strengths, creating a truly integrated player spanning from, resource extraction right through to direct retail services. This merger immediately positioned the new entity as a pivotal force in global food production, creating a truly immense scale of operations.
And when you say immense, what kind of scope and scale are we truly talking about here? Can you paint a picture of their global footprint?
Yeah, we're talking about an operation that touches nearly every corner of the agricultural world. Nutrien produces and distributes over 27 million tons of essential crop inputs annually. These are primarily potash, nitrogen, and phosphate. To put that in perspective, imagine a continuous chain of fully loaded cargo ships stretching across oceans, just delivering these vital components. In 2024 alone, they supplied these indispensable fertilizer products to customers in more than 50 countries.
50 countries. Okay.
Their operational footprint is vast, spanning 13 countries, and supported by a dedicated global workforce of nearly 25,000 employees.
Hmm.
Essentially, they are a fundamental pillar supporting agricultural productivity and global food security, from the individual farm field all the way through to industrial applications. They're ensuring the very foundation of our food supply remains robust.
That truly is a monumental operation. And it's clear this isn't just about digging raw materials out of the ground. You mentioned it's a comprehensive, integrated approach. What are the main business segments that truly drive Nutrien's growth and define its strategic advantage?
Right. If we connect this to the bigger picture, Nutrien's integrated business model is, without exaggeration, central to its resilience and market dominance. It's not a single-point business. It's a comprehensive, multifaceted approach divided into four primary segments that synergize and reinforce each other.
Okay, let's delve into their retail segment first. That's Nutrien Ag Solutions, right? This sounds like the direct link, the face of the company for many farmers, wouldn't you say?
Absolutely. The retail segment, operating under the banner of Nutrien Ag Solutions, is the largest agricultural retailer in the entire world.
The largest. Wow.
Yep, it serves as Nutrien's direct conduit to the grower, offering more than just products. Through an extensive physical network of over 2,000 retail locations,
2,000 locations.
spread across 7 key agricultural countries, including North America, South America, and Australia. They distribute a comprehensive range of crop inputs. This covers everything from crop nutrients and crop protection products to specialized seeds and general farm merchandise. But the vision extends beyond mere distribution. Nutrien aims to be a genuine one-stop shop for farmers, providing essential services, expert agronomic advice, and increasingly sophisticated digital solutions that help growers optimize their operations and make, data-driven decisions.
So it's not just about selling a bag of fertilizer or a packet of seeds. It's about providing that holistic support and expertise to the farmer. How incredibly significant is this retail arm to Nutrien's overall business and its bottom line?
Oh, it's critically significant. In fact, it's their single greatest revenue driver.
Really?
Yeah. This segment services an astounding 500,000 grower accounts globally.
500,000?
In 2022, for instance, it accounted for 57.7% of Nutrien's total revenue. That generated approximately $21.35 billion USD with an adjusted EBITDA of $2.3 billion. And what's truly impressive is the pace of its expansion. It's shown a remarkable 60.7% growth since just 2019.
Wow, that's huge growth.
It is. Picture a farmer in, say, Iowa or a rancher in Australia needing advice on everything from soil health and optimal seed varieties to precise fertilizer application and even financing for their operations. Nutrien's extensive retail network aims to provide it all, offering a truly integrated solution right at the local level. This deep relationship with the farmer is a powerful competitive advantage.
That's a truly massive distribution and service network, giving them an incredible reach. Okay, next let's talk about potash. That's a critical nutrient that we often hear highlighted in discussions about global food security.
Potash is, without question, a vital component of modern agriculture, and Nutrien stands as the world's largest potash producer.
Again, the largest. They seem to like being number one.
They do. They command over 20 million tons of potash capacity across 6 lower-cost mines, primarily located in Saskatchewan, Canada. What's particularly strategic here is their access to roughly 40% of the world's largest known global potash reserves, situated within a politically and economically stable geopolitical environment.
That stability is key, I imagine.
Absolutely. That combination of vast reserves and stable geography provides a significant, enduring competitive advantage that few others can match.
You mentioned a flexible 6-mine network. That sounds like a strategic asset. What does that flexibility mean for their supply capabilities and their ability to react to market changes?
Yeah, that flexible network is indeed a core strategic asset. It's almost like a built-in shock absorber for market fluctuations. It minimizes supply risk by allowing them to optimize production across different sites and enables Nutrien to efficiently increase production to meet sudden surges in demand at a relatively low cost. For example, they have concrete plans to ramp up to approximately 18 million tons in annual operational capability by 2026. And they can achieve this with a remarkably low capital cost, estimated at just $150 to $200 per ton.
That's incredibly low cost for that kind of ramp up.
It is. The significance of potash cannot be overstated. It typically accounts for about 50% of Nutrien's EBITDA and a staggering 70% of its production capacity.
Wow, 70% of capacity.
With roughly 95% of potash used as fertilizer and, crucially, no commercial substitute as a potassium fertilizer source, it's an indispensable nutrient for global food production. This isn't just about a commodity. It makes potash a strategic global asset, positioning Nutrien as a gatekeeper for a resource that literally sustains billions. That's a level of market leverage few companies possess.
Right. That brings us to nitrogen, another essential nutrient that supports plant growth. How does Nutrien stack up in that market? Are they number one there too?
Hey, not quite number one, but they're a formidable player. They rank as the 3rd largest nitrogen producer globally.
Okay, still pretty high up.
Definitely. They boast an impressive over 7 million tons of gross ammonia capacity, which can then be processed into more than 11 million tons of total nitrogen products. Their extensive production network is strategically diversified, with facilities located across the U.S., Canada, and Trinidad. The company's strategic focus in this segment is kind of dual-pronged, maintaining low-cost, diversified production while also actively seeking opportunities for high-return, low-risk brownfield projects.
Brownfield meaning expanding existing sites, right? Not building totally new ones.
Exactly. Expanding and optimizing existing facilities rather than building entirely new ones from scratch. This also includes a strong emphasis on expanding their range of sustainable products, with a clear goal of significantly lowering their carbon footprint in this energy-intensive segment.
Okay, makes sense. And finally, rounding out their core nutrient offerings, let's look at phosphate. What's Nutrien's position there?
For phosphate, Nutrien is the 2nd largest producer in North America.
Number 2 again. Strong showing.
Yep. They sell approximately 3 million tons of finished product annually. They operate 2 large integrated phosphate mining and processing facilities, complemented by 4 regional upgrading plants, all located within the U.S. This integrated network allows them to produce and sell a wide range of fertilizer, animal feed, and industrial phosphate products, further diversifying their essential offerings and bolstering their comprehensive portfolio of crop inputs.
Okay, so that's the structure. Now, what's genuinely compelling about this next point is understanding how this vast integrated operation translates into tangible financial performance and what factors truly drive those numbers. Let's look at the 2022 data for a snapshot, which was quite a year.
Indeed, 2022 was a standout year for Nutrien. They experienced record earnings. This exceptional performance was largely a confluence of strong underlying agricultural fundamentals, essentially robust demand from farmers, coupled with significantly higher fertilizer selling prices across the board, and, importantly, excellent performance from its expanding retail business segment. Specifically, the potash and nitrogen segments were exceptionally strong contributors.
Can you give us a clearer picture of their revenue highlights from 2022? How did those specific segments contribute?
Certainly, the potash and nitrogen segments were major drivers in 2022, each contributing over 20% of total revenue. Potash accounted for 21.3%, bringing in $7.899 billion USD, while nitrogen contributed 20.3%, totaling $7.533 billion USD.
Wow, neck and neck there.
Pretty close. And what's crucial here is that both segments saw solid growth in 2022. Potash grew by 2.03% and nitrogen by 1.64%. The boost in potash earnings, in particular, was substantially driven by higher realized prices and strong offshore volumes. This is significantly influenced by geopolitical events.
You mean the sanctions, right, on Russia and Belarus?
Exactly. Those sanctions drastically reduced their potash shipments by an estimated 25–50% compared to 2021. That consequently tightened global supply and pushed prices considerably higher. So yes, global geopolitical events had a very direct and frankly positive impact on their top line in 2022.
So it's clear that global dynamics directly impacted their revenue. But what about the cost side of the equation? What were the primary cost drivers in 2022 for these segments, and how did they, navigate them?
Right, good question. For the potash segment, a primary and often fluctuating cost driver was provincial mining taxes in Saskatchewan.
Ah, taxes.
Yeah. These taxes are often structured to increase alongside higher potash selling prices. So while Nutrien benefited from elevated market prices, they also saw a corresponding rise in their tax expenses. It's a bit of a double-edged sword.
Got it.
In the nitrogen business, costs increased significantly due to higher natural gas prices, which is a major feedstock, and other raw material and input costs, particularly for electricity. This led to the ammonia controllable cash cost of product manufactured per ton increasing, influenced by both lower production volumes and these higher input costs. This demonstrates that Nutrien's financial performance isn't just about selling. It's about shrewdly navigating global supply shocks, managing fluctuating commodity prices for inputs, and contending with dynamic tax regimes to consistently deliver essential products to market. It's a complex balancing act. And this leads us to a crucial consideration. Why is Nutrien's market position so incredibly critical for the long term? The answer, at its most fundamental level, well, it boils down to inherent human needs and global demographics.
Right. You're talking about the relentless pressure of feeding an ever-growing global population, right? We just passed 8 billion people globally not too long ago.
Precisely. The global population reached an astounding 8.0 billion in mid-November 2022. That represents a dramatic and continuous surge from just 2.5 billion in 1950.
That's incredible growth.
It is. And this trajectory isn't slowing down soon. Projections indicate it will peak at around 10.43 billion by 2085. This isn't just an abstract statistic. It signifies an immense and escalating pressure on our global food systems.
Right.
The implications are clear. More humans to feed, coupled with the stark reality of less arable land available per capita and a global trend toward increasing demand for higher quality, often protein-rich, foods which typically require more intensive fertilization. All these things combine to create a consistent, strong, and unwavering demand for crop nutrients.
And within that narrative of increasing demand, potash truly plays a starring, almost irreplaceable role, doesn't it?
Indeed. Potash is truly indispensable. Approximately 95% of all potash produced worldwide is used directly as fertilizer. And here's the critical point. There's no commercially viable substitute for it as a potassium fertilizer source.
No substitute at all.
Nope. This lack of substitution makes its consistent supply absolutely essential for maintaining and enhancing global food production. What's even more compelling for Nutrien's long-term outlook is that global demand growth for potash has actually outpaced other primary nutrients, demonstrating an average annual growth rate of 2.8% between 2001 and 2021. Imagine a world adding billions more mouths to feed, with less land to do it. Nutrien sits squarely at the heart of ensuring that this fundamental need is met, literally from the ground up, providing a critical service that underpins global stability.
Okay, let's unpack this next point. Even with such undeniable long-term demand, the market for fertilizers can be quite a roller coaster. It's not always smooth sailing, is it?
Not at all. Despite the unwavering long-term demand for food, the short to medium-term market for agricultural commodities like, say, anhydrous ammonia and potash is notoriously characterized by significant price volatility. Farmers often delay purchases, waiting for optimal price points, which can lead to rapid price swings.
Right, trying to time the market.
Exactly. For example, in 2022, anhydrous ammonia prices fluctuated wildly, starting above $1,400 per ton before dipping to $1,183 per ton. Potash prices, which soared to over $800 per ton for much of 2022, saw a significant correction, falling to $645 per ton by early 2023.
That's a big drop.
It is. While these prices, ammonia at 137 tortinaculiters and potash at $645 in February 2023, remain high compared to the 2016-2020 averages of around 518 and 350 respectively, the rapid declines illustrate the inherent unpredictability and challenge of these markets.
So even though prices are still historically strong, that kind of rapid volatility can be a serious challenge for planning and profitability. Sven Carlin, PhD, in his insightful analysis really highlighted the cyclical nature of potash, didn't he?
He absolutely did. Sven Carlin's analysis underscores a fundamental principle of commodity markets. Periods of high prices inevitably trigger new investments and capacity expansions from producers eager to capitalize on the boom.
Makes sense. Chase the profit.
Right. But this often leads to eventual oversupply, which then drives prices down into periods of subdued profitability. Conversely, prolonged low prices curb investments, sometimes forcing less efficient producers out of the market, which eventually sets the stage for future supply gaps and the next price upswing. This cyclicality is a deeply embedded fundamental aspect of the potash market that Nutrien, and indeed any player, must navigate.
And looking ahead, there are some pretty substantial new projects on the horizon that could exacerbate this oversupply risk, potentially making the market even more challenging for producers. Is that right?
That's a critical point for investors to consider. Major future projects loom large. BHP's Jansen mine, for instance, is a colossal endeavor expected to add a substantial 8 million tons to global capacity.
8 million. That's huge.
It's roughly 10% of current global production. Then you've got German competitor K+ planning an additional 2 million tons. And even Nutrien itself has capacity additions of over 1 million tons in its pipeline to meet future demand. These combined additions, especially if they come online in close proximity, could potentially lead to periods of significant global oversupply. Carlin explicitly describes such a scenario as creating an ugly year for potash prices, where margins would be squeezed across the industry. This possibility represents a key short to medium-term risk for the stock. But what's truly fascinating here is how Nutrien strategically positions itself within this inherent cyclicality. Their deep vertical integration is an incredibly powerful mitigator, acting almost like a built-in shock absorber against these market swings.
Precisely. It sounds like they've engineered a system to weather these storms. Can you elaborate on how this vertical integration from wholesale production right down to the farmer's field truly acts as such a robust economic moat?
Yeah, think of it this way. Because Nutrien controls the entire journey from the mine to the farm, they can dynamically adjust production, manage pricing, and even tailor products in a way that competitors who specialize in just one part of the value chain simply cannot. This integration allows them to calibrate their wholesale production plans in direct response to real-time market demand signals coming from their retail arm. They can do this at a relatively low and stable cost, significantly cushioning the impact of volatile commodity price fluctuations. It gives them leverage to influence different areas of the value chain, ensuring supply reliability for their retail customers, and even developing unique proprietary products based on specific grower needs. This direct control and feedback loop from the farmer gives them unparalleled flexibility and market intelligence.
Okay. So beyond this powerful vertical integration, what other competitive advantages, or economic moats as they're often called, does Nutrien possess that fortify its market position?
Well, they have several layers of competitive advantage, I'd say. Firstly, their diversified business model is a major strength. They offer a truly comprehensive portfolio that extends beyond just potash, nitrogen, and phosphates to include seeds, crop protection products, and highly valuable agronomic services.
Mhm.
This diversification allows them to cater to the distinct needs of different crop types and geographic regions. For example, in Australia, Nutrien provides a full suite of solutions, including specialized inputs for livestock and water management, which are crucial for that market.
Got it.
Secondly, the success of Nutrien Ag Solutions, their retail arm, is a significant moat in itself. Their whole acre solutions approach allows them to address a farmer's entire operational needs, from soil analysis to harvest strategies. This also strategically positions them to influence growers towards adopting climate-smart agriculture practices and soil carbon sequestration, potentially connecting them to burgeoning carbon markets, which could become a significant new revenue stream in the future.
Interesting. And it sounds like they're not just growing organically, they're also aggressively expanding through strategic acquisitions. That's another piece.
That's their third moat, yeah. A robust acquisition capability. Nutrien has demonstrated a consistent ability to grow strategically through targeted acquisitions. In 2022 alone, they completed 21 acquisitions across key markets like the U.S., Brazil, and Australia.
21 in 1 year.
Yeah. A particularly notable example is the acquisition of Casa Duadua S.A. in Brazil that significantly expanded Nutrien's retail footprint in that country from just 5 states to 13 states. This highlights a deliberate strategy of growth through M&A to consolidate market share and enter high-growth regions.
And Brazil seems to be a particularly hot market for them. Is there a strong rationale behind that focus?
Oh, there's a very strong rationale, and that constitutes their fourth competitive advantage: the immense agriculture market prospect in Brazil. Brazil is not just one of the world's largest, but also one of its fastest-growing agriculture markets. It's currently the largest soybean producer globally, possesses ample unfarmed land with significant potential for expansion, and benefits from favorable government policies that support agricultural growth. The USDA, for instance, projects that an additional 20 million hectares of cropland will be brought into production in Brazil by 2031. This confluence of factors makes Brazil an incredibly strategic and high-growth focus for Nutrien's expansion efforts.
Okay. So with all these advantages, they're still battling it out with some major global players, I imagine, who are their main competitors in this vital sector.
Indeed, the market is competitive. Their key competitors include some very sophisticated companies. Syngenta, for instance, is a major force, particularly strong in ag tech and AI-driven solutions, pushing innovation in digital farming that could pull farmers towards different service models.
Right, the tech side.
Exactly. Then there's Yara International, a Norwegian chemical company that also focuses on nitrogen, phosphate, and potash, and is a leader in sustainable nutrient solutions, creating pressure for Nutrien to also innovate in green fertilizers. And finally, Eurochem Group, a Swiss producer with substantial capacity in all 3 primary nutrients. These aren't just names. Each presents a distinct challenge, forcing Nutrien to continually innovate and leverage its integrated model. Think of it like a seasoned sailor navigating rough, competitive seas. They know storms are coming, but they have the right ship equipped with diversified businesses, low-cost production, and vertical integration, along with a powerful retail network to not just weather them, but to thrive.
Okay, great analogy. And now for something that ties all this together, what does all this mean for Nutrien's very recent performance? We just got their Q2 2025 results. Let's dive into what those numbers tell us.
That's right. The Q2 2025 results offer a fresh snapshot of their current operational and financial health. And Nutrien has reported an overall strong performance for the quarter. They achieved net earnings of $1.2 billion, which translates to $2.50 diluted EPS. Their adjusted EBITDA for the quarter stood robustly at $2.5 billion, indicating solid operational profitability.
Okay, strong quarter. And how does the first half of 2025 look compared to the same period in 2024? Did that growth continue?
Yeah, for the first half of 2025, Nutrien generated net earnings of $1.2 billion. That represents a truly significant 124% increase from $557 million in H1 2024.
Wow, 124% increase in net earnings.
A huge jump. Adjusted EBITDA also saw a modest but steady increase of 1% to $3.3 billion for the half year. This notable growth was primarily driven by a combination of higher fertilizer sales volumes and improved net selling prices across their portfolio. Ken Seitz, Nutrien's president and CEO, specifically highlighted strong operational performance, record potash sales volumes, increased nitrogen operating rates, which is a testament to improved efficiency, along with lowered expenses, optimized capital expenditures, and a consistent return of cash to shareholders, totaling $0.8 billion in H1 2025 alone.
And what's the CEO's perspective on the broader fertilizer market fundamentals that supported these impressive results?
Seats emphasize that the underlying fertilizer market fundamentals remain exceptionally strong. This strength is supported by persistent global demand, ongoing supply disruptions in various regions, and delays in competitor projects coming online.
Okay.
He specifically noted healthy customer engagement and robust field activity in North America, with farmers actively focusing on maximizing crop yield potential to meet global demand.
So yeah, these aren't just dry numbers. They tell a story of a company effectively navigating complex global markets, leveraging its strengths, and delivering on its strategic goals, even with, a few headwinds in certain segments.
Right. Let's really drill down into the segment-specific performance for Q2 and H1 2025 versus 2024, starting with their largest revenue driver, retail. How did that look?
Okay, for the retail segment, adjusted EBITDA came in at $1.149 billion in Q2 2025. That showed a modest 2% increase over the prior year's quarter. However, for the first half of the year, it was $1.195 billion, representing a slight 1% decrease compared to H1 2024.
This down slightly for the half year.
Yeah, and similarly, sales and gross margin also experienced a slight dip, decreasing by 1% in Q2 and 3% in H1.
A slight decrease in the first half for their largest segment. That's certainly something to examine. What were the primary factors influencing these changes in retail performance?
The primary factors were largely weather-related and regional. Dry weather conditions in Australia and persistently wet conditions in the southern U.S. significantly impacted crop input sales and margins in those specific regions.
Weather strikes again.
Always a factor in ag. This highlights how susceptible even the largest agricultural retailers are to local farm conditions. However, these negative impacts were partially offset by proactive measures like lower operating expenses and, crucially, higher crop nutrient volumes sold in North America. There were also lower sales and gross margins for crop protection products influenced by the Australian conditions and shifts in product mix, and for seeds primarily in the southern U.S. due to adverse weather and fewer acres being planted. This tells us that while Nutrien is the world's largest agricultural retailer, even they aren't immune to regional challenges like tough weather.
Makes sense. And how did their proprietary products, which are often higher margin, along with Nutrien Financial, perform within the retail segment? Did they help offset some of that?
They did. Proprietary products continued to be a strong and strategic contributor, accounting for a solid 29% of the gross margin in Q2 and 27% in H1. This demonstrates the success of their investment in unique high-value offerings. Nutrien Financial, their in-house financing arm, also maintained a stable adjusted net interest margin of 5.3% for the rolling 4 quarters ended June 30th, 2025. That shows consistent performance and provides crucial financial support services to their growers.
Okay. Moving on to potash, a core and often headline-grabbing segment for Nutrien. How did it fare in the second quarter and first half of 2025? Better news there.
Oh yeah, the potash segment truly delivered strong growth. Adjusted EBITDA increased to $630 million in Q2, marking a substantial 33% jump compared to the previous year.
33%, wow.
And reached $1.076 billion for H1, up a healthy 7%. This excellent performance was fundamentally driven by a combination of higher net selling prices and, impressively, record sales volumes.
Record sales volumes, that's particularly impressive, especially when we consider the cyclical market dynamics and potential for oversupply we discussed earlier. What drove that record performance?
Indeed, it's a testament to robust market demand right now. Sales volumes for Q2 were the highest on record at 3.989 million tons, and for H1, they hit an all-time high of 7.391 million tons.
Okay.
This remarkable volume was supported by healthy potash affordability for farmers and strong underlying demand in North America and key offshore markets. The average net selling price also saw a healthy increase, reaching $248 per ton in Q2, up from $212 in Q2 2024, and $235 per ton in H1, up from $225 in H1 2024. This was largely propelled by higher benchmark prices in critical markets like Brazil and Southeast Asia, even with a slight offset from slightly lower North American prices.
But I assume those higher provincial mining taxes also kicked in.
You got it. This stellar performance was partially offset by higher provincial mining taxes, that cost driver we previously discussed, which naturally increased with higher selling prices.
And what about the cost of goods sold for potash? Were they able to maintain their low-cost producer status amidst those volumes?
Well, the cost of goods sold per ton for potash did see an increase in both Q2 and H1 2025. This was primarily due to higher depreciation charges and lower planned production volumes, which can impact per unit costs. along with higher turnaround costs associated with maintenance. The controllable cash cost of product manufactured per ton also rose to $57 in H1 2025, up from $53 in H1 2024, reflecting these operational factors. So while volumes and prices were up significantly, costs also face some upward pressure.
Okay. Next, let's look at the nitrogen segment, another crucial part of their portfolio. How did that perform?
The nitrogen segment also delivered a strong performance for Nutrien. Adjusted EBITDA increased to $667 million in Q2, up a solid 12%,
12%. Good.
and reached $1.075 billion for H1, showing a 2% increase. These gains were primarily driven by higher net selling prices and increased sales volumes, reflecting robust demand and greater production of both ammonia and upgraded nitrogen products.
And what about operational efficiency in nitrogen? Was that a factor? We talked about their focus there.
It was. A key highlight in this segment is the record ammonia operating rate of 98% achieved in the first half of 2025.
98%. That's running flat out.
Pretty much. This reflects significant improvements in reliability and operational efficiency across their nitrogen facilities, which is a testament to their ongoing capital expenditure for optimization. However, these positive drivers were partially offset by higher natural gas costs, a critical input for nitrogen production.
The input costs again.
Yep. The overall natural gas cost reached $3.61 per MMBtu, that's million British thermal units, in H1 2025, up from $2.98 in H1 2024. This fluctuation clearly illustrates the direct impact of energy prices on their cost structure and profitability in this segment.
Right. Finally, let's turn our attention to the phosphate segment. How did it perform compared to the others?
Phosphate saw adjusted EBITDA of $92 million in Q2, marking a 5% increase. This was primarily due to higher net selling prices, though these gains were partially offset by lower sales volumes and higher sulfur input costs, as sulfur is a key raw material for phosphate production.
Okay, so Q2 was up slightly. What about the first half?
For the first half of the year, however, adjusted EBITDA decreased by 27% to $153 million.
Oof, down 27%. That's significant.
It is. This H1 decline was predominantly attributed to lower production volumes and persistently higher sulfur input costs, despite the benefit of those higher net selling prices. The P2O5, or phosphorus pentoxide operating rate for H1 2025 was 73%, down from 80% in H1 2024, reflecting these production challenges and the impact of planned turnarounds. So phosphate faced some headwinds in the first half.
Okay, so this brings up a key strategic point. How does Nutrien manage its capital to not only sustain this massive global operation, but also to consistently continue rewarding its shareholders? It's a, complex balancing act.
Right. It's all about effective cash flow generation and how they strategically allocate it, isn't it? Where's the cash coming from? Where's it going?
Exactly. And the good news is cash provided by operating activities saw a significant increase. It rose by a robust 40% in Q2 and 10% in H1 2025.
40% jump in Q2 operating cash flow. That's strong. Very strong. This strong cash generation was primarily driven by higher fertilizer sales volumes, improved net selling prices, and lower cash income taxes paid in the period. This robust operational cash flow provides the essential foundation for all their capital management decisions, allowing them flexibility.
So with that strong cash flow, how are they choosing to invest it back into the business for future growth and efficiency? What are the CapEx plans?
Total capital expenditures for the full year 2025 are projected to be between $2.0 and $2.1 billion. What's interesting is that this is actually slightly below the prior year's spend, suggesting perhaps a more targeted approach.
Dialing it back a bit.
Potentially, or just being more focused. This includes a significant allocation of $500 million specifically designated as investing capital. These investments are strategically channeled into key areas: proprietary products development within retail, network optimization, and enhanced digital capabilities to boost efficiency, low-cost brownfield expansions in their nitrogen segment to increase capacity, and crucial mine automation projects in potash to further drive down operating costs and enhance safety. This demonstrates a focus on strategic, high-return investments that reinforce their competitive advantages rather than just, increasing overall spend indiscriminately.
And what about their commitment to returning value directly to their shareholders, which is often a key consideration for investors? Dividends, buybacks?
Yeah, Nutrien has a clear and consistent commitment to returning cash to shareholders. In the first half of 2025, they returned a substantial $0.8 billion through a combination of regular dividends and strategic share repurchases.
Okay, $800 million back to shareholders in 6 months.
Specifically, as of August 5, 2025, they had repurchased 5.7 million shares for a total of $316 million. This dual approach of dividends and buybacks reflects a balanced strategy to reward investors while also potentially enhancing shareholder value by reducing the outstanding share count.
How does their debt structure look as they make these investments and shareholder returns? Is it well managed? Are they taking on too much debt?
Well, their long-term debt did see an increase due to the issuance of $1.0 billion in senior notes in the first half of 2025. They undertook that to optimize their capital structure and ensure ample liquidity. This was, however, partially offset by a $500 million repayment of existing senior notes, so net increase of $500 million there.
Yeah.
Overall, Nutrien maintains a substantial total credit facility limit, approximately $8.03 billion, with a manageable $1.934 billion utilized as of June 30, 2025. This indicates a well-managed debt structure with considerable financial flexibility and ample liquidity available for future needs. Think of it as carefully managing a multinational household budget, but instead of just groceries, you're investing billions in global infrastructure, hedging against geopolitical risk, and navigating commodity price swings, all while consistently rewarding those who've invested in them.
Right, a slightly more complex household budget. So looking ahead, what's on the horizon for the rest of 2025? What kind of guidance are they providing us, and what does it tell us about their expectations for the back half of the year?
Yeah, Nutrien has indeed provided updated guidance for 2025, reflecting their most current market outlook and operational expectations. These updates are crucial for understanding their strategic direction for the remainder of the year.
Let's start with potash, which saw those record sales volumes in the first half. Are they expecting that to continue?
For potash, yes, reflecting that strong first-half performance and expected market conditions, they've actually raised their full-year sales volume guidance.
Oh, raised guidance. Good sign.
Yeah. It's now projected to be between 13.9 and 14.5 million tons. That's an increase from their previous estimate of 13.6, 14.4 million tons. This upward revision is driven by expectations for continued higher global demand. They've also raised the global potash shipment forecast to 73-75 million tons. This forecast is supported by healthy affordability for farmers, relatively low channel inventories globally, and recent favorable contract settlements with major markets like India and China, which provide a clear demand signal.
Okay, positive outlook for potash. And what about the retail segment, their biggest revenue driver, especially after those mixed results in the first half due to weather? What's the guidance there?
Retail adjusted EBITDA guidance is set at a range of $1.65 to $1.85 billion. This forecast is underpinned by several key assumptions for the second half of 2025. It anticipates higher North American crop nutrient and crop protection sales compared to 2024. Crucially, improved moisture conditions in Australia after a dry start to the year.
They need that rain.
They do. And a continued recovery in the critical Brazilian market. So, yeah, they're expecting a rebound in the latter half of the year for the retail segment.
Okay, how about nitrogen and phosphate? What's the outlook there for the rest of 25?
For nitrogen, the sales volume guidance is between 10.7 and 11.2 million tons. However, they are anticipating slightly lower ammonia operating rates in the second half of the year.
Lower rates. Why is that?
It's not due to demand issues, but rather planned turnaround activities at their North American plants. These are routine maintenance cycles necessary for long-term operational reliability and efficiency. So, planned downtime.
Got it. Scheduled maintenance.
Exactly. For phosphate, the sales volume guidance is 2.35 to 2.55 million tons, with expectations of improved operating rates and sales volumes in the second half, following the completion of those planned turnarounds and other operational adjustments that impacted production in the first half of 2025.
Okay. So what are the broader market trends influencing this guidance, and what's shaping the landscape for the rest of 2025? What are they watching?
Several key trends are actively shaping the market right now. While favorable crop production prospects in the U.S. and Brazil have, paradoxically, put some downward pressure on crop prices by increasing supply.
Home supply, lower prices, yeah.
Right. But the underlying demand for crop inputs remains robust. Farmers continue to prioritize maximizing yield potential, meaning they'll still invest in quality fertilizers and seeds to get the most out of every acre. Brazilian soybean acreage, for instance, is expected to increase, which will strongly support crop input purchases down there. In Australia, timely rains have significantly improved winter crop prospects, boosting demand in that region.
Good news for Australia.
Yeah. Globally, urea and ammonia prices are expected to remain tight or even strengthen due to persistent demand, unplanned outages at various plants, and ongoing project delays from competitors. Phosphate markets are also anticipated to remain tight due to limited global supply, partly exacerbated by Chinese export restrictions. So, even the most robust companies face a constantly shifting landscape. These guidance updates show Nutrien's real-time adjustments to market conditions and operational realities. It's a continuous balancing act.
Okay, so this leads us to a really crucial consideration. What are the significant headwinds Nutrien faces in this vital sector? And maybe more importantly, how are they actively addressing these challenges? It's not just about opportunities, right? It's also about managing risk effectively.
Definitely. Let's start with climate-related risks. These are increasingly important for any company, particularly one so deeply tied to global agriculture. These aren't just abstract environmental concerns anymore, are they? They have real teeth. Not at all. They have very tangible impacts. Nutrien faces high-impact, direct physical risks from a changing climate. We're talking about more intense weather events like devastating floods or prolonged droughts, rising sea levels affecting coastal operations, and unpredictable shifts in temperature and precipitation patterns.
Yeah.
These directly impact their mining operations, the agricultural practices of their customers, and the stability of their global supply chains. It's all interconnected. Beyond that, there are significant transition risks driven by global decarbonization ambitions and the accelerating energy transition.
Right, the shift away from fossil fuels.
Exactly. This translates into evolving carbon regulations and pricing mechanisms, which directly impact Nutrien through potentially increased compliance costs. And it also influences how investors allocate capital, favoring companies with clear decarbonization pathways. For instance, their Canadian manufacturing facilities are already subject to carbon taxes that are on an upward trajectory, so that's a direct financial hit.
So, climate risk isn't just an ethical consideration, it has very real financial and operational implications. What about broader macroeconomic conditions and geopolitical events? Those seem like constants these days.
They really do. Another major headwind is the pervasive volatility of macroeconomic conditions. This is a broad category encompassing various factors. The imposition of trade tariffs between nations, general global market volatility that impacts commodity prices, persistent supply chain constraints, increased price competition from rivals, and unpredictable shifts in agricultural production or consumption trends.
The long list.
It is. Any of these can lead to lower crop prices for farmers, which in turn reduces their purchasing power and demand for Nutrien's products. Furthermore, geological and geopolitical events can cause significant supply disruptions. We saw a stark and impactful example of this in 2022 when the international sanctions imposed on Belarus and Russia drastically reduced their potash shipments by an estimated 25–50% compared to 2021.
Right, we touched on that impact earlier.
Yeah, that single event had profound implications for global supply, trade flow patterns, and pricing, underscoring the fragility of global supply chains. Things can change fast.
Definitely. And what about social and governance risks within the company itself, the internal challenges they need to manage day to day?
Right. On the social and governance front, Nutrien has clearly identified cybersecurity threats and the complexities of talent acquisition and organizational culture as ongoing social risks.
Cybersecurity is huge everywhere now.
Absolutely. In an increasingly digital world, a major cybersecurity breach could not only halt their retail operations and compromise sensitive farmer data, but also severely erode the trust that is paramount in the agricultural sector. And talent management, in a sector experiencing demographic shifts and a global race for specialized agricultural technology skills, retaining top talent and fostering a strong, inclusive culture is absolutely vital for long-term innovation, operational excellence, and sustained growth. You need the right people.
Okay, so what's genuinely compelling about this next point is that Nutrien isn't just identifying these problems, they're actively working on robust solutions, truly demonstrating strong ESG leadership. How are they mitigating these significant environmental challenges we just discussed?
Yeah, Nutrien has implemented remarkably robust and, I'd say, forward-thinking environmental mitigation strategies. For those physical risks, they leverage advanced weather analytics systems to provide their growers and crop consultants with new perspectives, helping them better manage weather-related risks on their farms. Their comprehensive whole-acre solutions approach and continuous investment in agricultural technology are designed to improve soil health, enhance soil organic carbon sequestration, effectively pulling carbon out of the atmosphere, optimize nutrient use efficiency to reduce waste, reduce overall GHG emissions from farming, and improve water quality.
So helping farmers adapt, too.
Exactly. This holistic approach empowers farmers to adapt to changing conditions and build greater resilience.
And for those transition risks related to decarbonization and the global energy shift, what are they doing on their own operational side?
To effectively manage transition risks, Nutrien is implementing various efficiency and emissions reduction projects across their operations. These include advanced cogeneration at facilities like Carseland, Alberta, and Quarry, Saskatchewan, which simultaneously produces electricity and useful heat, improving energy efficiency.
Okay.
They are also actively engaged in carbon capture, utilization, and storage (CCUS) projects, such as supplying captured CO2 from their Redwater, Alberta nitrogen facility to the Alberta Carbon Trunk Line.
Right. CCUS is getting a lot of attention.
It is. They are rolling out innovative N2O abatement technologies, nitrous oxide being a potent greenhouse gas exploring renewable energy options, and crucially, developing low-carbon and clean ammonia production. That includes plans for what could be the world's largest clean ammonia production facility down in Louisiana.
World's largest. That's ambitious.
Very. These initiatives are all strategically aimed at significantly reducing their Scope 1 and Scope 2 GHG emission intensity.
Do they have specific measurable targets for these emissions reductions? Are they putting numbers on it?
Yes, they do. Nutrien is unequivocally committed to achieving at least a 30% reduction in Scope 1 and Scope 2 GHG emission intensity by 2030 using a 2018 baseline.
30% by 2030. Okay.
And they've already made demonstrable progress, having achieved 4% and 14% reductions in Scope 1 and Scope 2 GHG intensity, respectively, in 2022 compared to that 2018 baseline. It's important to recognize that their nitrogen segment, due to its energy-intensive processes, is currently the largest contributor to their overall GHG emissions, making those specific reduction initiatives particularly impactful and central to achieving their overarching targets.
That truly is a comprehensive environmental strategy. How do they address the macroeconomic volatility and supply chain disruptions we discussed earlier? What's the plan there?
For macroeconomic mitigation, Nutrien heavily relies on its flexible operations and its inherently reliable, vertically integrated supply chain. We keep coming back to that integration.
Yeah, seems key.
It is. They maintain low-cost operations and, crucially, possess the ability to rapidly adjust their production plans. For instance, they can strategically pull forward maintenance activities during periods of lower demand, preserving the flexibility to quickly ramp up production when market demand reemerges. This agility allows them to respond efficiently and cost-effectively to shifting market needs. Their strategic plan to ramp up annual operational capability to approximately 18 million tons by 2026 is a key part of this overall operational flexibility and supply resilience.
Okay. And what about the internal social and governance risks, like cybersecurity and talent management? How are they safeguarding themselves there?
Right. On the social and governance front, Nutrien promotes a strong culture of cybersecurity awareness throughout the organization. This is reinforced by regular simulated phishing exercises and targeted training for employees to minimize human error, the weakest link often. For talent management, they are deeply committed to fostering employee career development and continuous learning, utilizing incentive programs to encourage ongoing skill enhancement and retention in a competitive labor market. Their corporate governance structure appears robust, with executive compensation clearly tied to pay for performance and critical ESG metrics, directly aligning leadership incentives with long-term collective goals.
Tying pay to ESG, that's becoming more common.
It is, and it's important. Furthermore, their board members possess diverse expertise spanning leadership, strategy, sustainability, innovation, and operations, ensuring a well-rounded oversight.
So it really sounds like it's not just about compliance for them, but truly embedding these ESG principles into their core business model as a competitive advantage.
Exactly. Their ESG assessment profile from 2022 offers tangible evidence of this commitment. They outperformed peer averages across major ESG ratings from MSCI, S&P, and Sustainalytics, and demonstrated consistent improvement since 2019. This is incredibly significant because their unique vertical integration, extending from the mine all the way to the farm, gives them an unparalleled ability to influence and manage carbon across the entire agriculture value chain. This isn't just about good corporate citizenship. It's about embedding sustainability deep into the business model as a core competitive advantage and a vital risk management strategy for the future. Okay, so this brings up a crucial consideration, maybe the bottom line for many listeners. What does all this extensive detail and analysis ultimately mean for someone contemplating Nutrien as a potential investment? What are the key takeaways from an investment perspective?
Right. It seems analysts have had varied but generally positive views over time. Let's start with the undervaluation thesis presented in that Next Gen Investors Endowment report you mentioned earlier. What did that say?
Yeah, the initial DCF, or discounted cash flow analysis from the Next Gen Investors Endowment Report back in October 2023, offered a compelling perspective at the time. It suggested that Nutrien was undervalued, with an implied share price of $63.85 per share versus a then-current market price of $58.87 per share. That represented a potential upside of about 8.5%.
Okay, modest upside based on that analysis.
At that point, yeah. This valuation was predicated on fundamental assumptions that Nutrien would successfully maintain its market share in a continually growing industry and achieve a sustainable perpetuity growth rate of 1.83%. So, for long-term investors, this report highlighted a potential entry point for a quality asset, assuming those assumptions held.
And Sven Carlin, PhD, in his analysis, also highlighted some significant positive secular tailwinds, providing a kind of underlying safety net for investors, didn't he?
Yes, he really emphasized those long-term, irreversible drivers that provide a kind of a margin of safety for investment, even if short-term cyclicality creates challenges.
Right, the big picture trends.
Exactly. These include the unstoppable force of global population growth, the shrinking amount of arable land available per capita, and the increasing global demand for higher quality, more protein-rich foods. Garland argues that even if you make a mistake on the timing of a cyclical commodity, these powerful fundamental trends will ultimately support the investment over the long term, making Nutrien a relatively low-risk, foundational holding in his view.
And Nutrien's operational structure, with its deep vertical integration and impressively low production costs, plays a big role in strengthening this investment case, I assume.
Absolutely. Nutrien's ability to operate as a low-cost potash producer is a tremendous competitive advantage. Their cash costs are estimated to be around $50 per ton, which is exceptionally low globally.
$50 cash cost? Wow.
Yeah. Even after factoring in capital costs and provincial mining taxes, their break-even point remains closer to maybe $200 and $250 per ton. This cost efficiency, combined with the stable, recurring revenue from its diversified retail business, makes it a relatively low-risk, long-term investment in Carlin's view. He specifically points out that because of this financial resilience and strong cash generation, Nutrien's dividend is highly unlikely to be cut, offering a reliable income stream even through market downturns.
Right, that dividend security is important for many. Speaking of dividends, what were Carlin's estimates on Nutrien's cash flow and its commitment to shareholder returns?
Carlin estimated Nutrien's free cash flow at approximately $1.5 billion based on his modeling at the time. He noted this is comfortably sufficient to sustain a robust dividend of $1.08 per share. That translated to an attractive yield of 4.71% based on prices at the time of his analysis.
Okay, pretty decent yield.
Yeah. He also highlighted that the company isn't just relying on dividends. It's active in strategic share buybacks when it has excess cash, further returning value to shareholders by reducing the share count. Overall, this combination of stable dividends, potential for buybacks, and strong underlying fundamentals makes for an attractive proposition in the current environment due to its stability and strong underlying fundamentals, particularly for income-focused or value investors.
Okay, so with all these factors in play, what could the future truly hold for Nutrien? It's always tough to predict, but let's look at some potential scenarios that Sven Carlin thoughtfully laid out to help us understand the range of possibilities. He broke it down right.
Yeah, it's always crucial to consider a range of possibilities, especially with a business tied to cyclical commodities like Nutrien. Carlin explored 3 distinct scenarios for the company's future performance, which can guide our understanding.
Okay, let's start with the more conservative or even negative scenario. What would an ugly year, as he put it, look like for Nutrien?
Right. In a negative scenario, Carlin considered what would happen if potash prices remained stubbornly closer to that $200 per ton break-even level for an extended period. This could occur, for example, if significant new supply were to flood the market, such as BHP's massive Jansen project coming online by 2025 and ramping up quickly, really disrupting things.
Right, that Jansen project is the big unknown.
It really is. In this environment, Nutrien's free cash flows could potentially drop to about $1 billion. Now, while this amount would still be enough to comfortably cover their dividend,
It's still covering the dividend, okay.
yeah, that's key. But Carlin suggests the market capitalization could fall significantly, perhaps to around $12 billion, implying a much lower multiple on free cash flow, maybe 10 to 12 times. However, a key point for income investors is that even in this ugly year scenario, the dividend would likely remain stable due to their low-cost production and integrated model. So the downside might be more in share price than income, potentially. This represents the biggest short to medium-term risk for the stock.
Okay. What about the more likely or base case scenario? What does that trajectory look like according to Carlin?
In the base case, Carlin anticipates a more optimistic yet grounded outlook. He projects that while cash flows might experience a subdued period for a year or two as the market digests new supply or other headwinds,
A bit of a soft patch.
potentially, but then they would steadily rise to a healthy $3 billion annually. This growth would be driven by the powerful long-term secular tailwinds we discussed earlier, sustained global population growth, increasing food demand, and the continuous need for crop nutrients alongside Nutrien's own operational growth activities, like capacity expansions and retail network optimization. This scenario would likely lead to higher dividends and a gradual appreciation in the stock price, with the potential market capitalization exceeding $30 billion in a few years. That would offer solid double-digit returns for patient investors from current levels.
Okay, $30 billion plus market cap in the base case. And then the best case scenario for when everything aligns perfectly and market conditions are exceptionally favorable. What happens then?
The best-case scenario envisions a powerful confluence of factors. This would involve Nutrien effectively bringing its idled production capacity online precisely when global demand surges and potash prices return to sustained higher levels, perhaps revisiting the highs seen back in 2022.
Back over $800 a ton, maybe?
Potentially, yeah. In this boom environment, free cash flows could easily surpass $4 billion annually. Combined with market exuberance, likely leading to increased share buybacks to capitalize on the lower share count and higher dividends, this could propel Nutrien's market capitalization to $60 billion or more.
60 billion, that's a huge jump.
It would be, yeah. These scenarios powerfully remind us that even strong foundational companies operate within a spectrum of possibilities, and understanding those potential ranges helps inform a truly balanced investment perspective. It's not just one number.
Absolutely. So, what does this all mean for you, the listener? We've really taken a deep dive into Nutrien Ltd today. We've looked at its foundational business segments, their impressive scale, its recent financial performance, the long-term trends shaping its future, and even various investment scenarios.
Yeah, we've seen a company strategically positioned at the absolute epicenter of global food production in a world that critically depends on its products. Nutrien seems to adeptly balance navigating often cyclical commodity markets with robust internal capabilities and a clear, forward-looking focus on sustainability. The interplay between relentless global population growth and the finite diminishing resources of arable land truly highlights their essential, almost irreplaceable role in our collective future.
What's genuinely compelling here is that Nutrien's story isn't just about massive scale and essential resources. It's about the complex, ongoing challenge of feeding a growing planet. It's a fundamental piece of our global infrastructure, really.
It really is. And this brings up a critical question for you, the listener, to consider as we wrap up. As global agriculture continues to innovate and adapt to both climate change and ever-increasing demand, which of Nutrien's strategic initiatives do you think will ultimately have the most significant long-term impact? Will it be their whole acre solutions approach directly empowering farmers with data and services? Or perhaps their ambitious commitment to cutting-edge clean ammonia production, aiming to decarbonize a key input? Which one do you think will ultimately have the most significant long-term impact on global food security and their competitive standing in the decades to come? Something to mull over.
Definitely something to think about. Thanks for joining us on this deep dive into Nutrien. We hope you feel much more informed and ready to explore these fascinating foundational topics further.